Hi, welcome to Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 9 a.m., noon, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Well, something unusual just happened in Washington. Not a market crash, not a crypto ban, not another regulatory lawsuit. Instead, a quiet policy signal appeared in a government strategy document, and buried inside that language was something that could reshape how the United States and possibly the world views blockchain technology. For the first time, digital asset infrastructure was discussed alongside technologies that governments consider critical to national competitiveness. Technologies like artificial intelligence, quantum computing, cybersecurity systems. Now that might sound like bureaucratic wording, but in financial history, language like this often appears before major technological shifts. And when analysts started connecting the dots across global payments, tokenized finance, and institutional infrastructure, two names kept appearing, XRP and Stellar. But to understand why, we have to zoom out, because this story isn't really about crypto prices. It's about the possible rewiring of global financial infrastructure. I just want to take the time to thank everybody that likes, subscribes, and comments and shares these videos. These few things really do help the channel out a lot and gets this content to more people that should be in the know. And that's the story made just beginning, the bigger macro story. Every generation of finance has its infrastructure moment. In the 1800s, the telegraph transformed markets. Before telegraphs, information traveled as fast as a horse could run. Prices in New York and London could differ dramatically because traders simply didn't know what was happening across the ocean. But once telegraph lines connected markets, something extraordinary happened. Prices synchronized, liquidity expanded, and global finance became faster and more efficient. Fast forward to the late 20th century, electronic trading replaced physical trading floors. Orders that once took minutes suddenly took milliseconds. Entire asset classes exploded in size because the infrastructure made them easier to trade. Now ask yourself a question. What happens when money itself moves at internet speed? Because that's the promise many blockchain developers have been chasing for over a decade. And suddenly, policymakers are starting to pay attention. A shift in government thinking. For years, the debate around cryptocurrency looks something like this. Should governments regulate it? Should it be banned? Is it safe? Is it speculative? But recently, something interesting started happening. The conversation began shifting. Instead of asking whether crypto should exist, policymakers started asking a different question. How do we secure and manage the infrastructure around it? That's a very different conversation, because once governments started discussing infrastructure, they're thinking long-term, ladies and gentlemen. Infrastructure decisions often shape economies for decades. And this is where things get interesting and spicy, because blockchain technology is increasingly being viewed not simply as a speculative asset class, but potentially as a settlement layer for digital finance. Let this sink in. Why global payments need an upgrade. Now let's zoom into one of the biggest inefficiencies in modern finance, cross-border payments. You might be assuming sending money internationally works the same way sending an email does, but it doesn't. In many cases, international transfers still rely on a network of correspondent banks. A payment might pass through multiple institutions before reaching its final destination. Each step can introduce delays, fees, and currency conversions. Sometimes settlement takes days, and for business moving large amounts of money globally, those delays can lock up enormous amounts of capital. Now imagine replacing that entire process with a digital network where value moves almost instantly. No long settlement chains, no multiple intermediaries, just direct value transfer. That idea is what originally inspired several blockchain payment networks. And two of the earliest examples were XRP and Stellar. The original vision behind XRP, years ago, when Ripple introduced the concept behind the XRP ledger, many people thought it sounded unrealistic. The idea was simple, but ambitious. Money should move the way information moves across the internet, instantly, globally, with minimal friction. Instead of waiting days for cross-border settlements, transactions could finalize in seconds. Instead of large fees, the cost could be fractions of a cent. And instead of multiple intermediaries, liquidity could move directly between currencies. At the time, this vision seemed far ahead of the existing financial system. Let this sink in. This is huge. But now the environment is starting to shift. because the global economy is becoming increasingly digital, and digital economies often demand faster infrastructure. The parallel story of Stellar. Here's an interesting twist in the story. Stellar was created by Jed McCabe, one of the early architects behind Ripple, but the mission of Stellar evolved slightly differently. While Ripple focused heavily on partnerships with banks and financial institutions, Stellar aimed to build infrastructure that fintech companies and payment providers could use, always. The goal was broader financial connectivity, helping move money across borders efficiently, especially in regions where traditional banking infrastructure is limited. Over time, this strategy began attracting institutional experimentation. Payment companies explored settlement solutions. Fintech platforms tested cross-border corridors, and asset managers began exploring tokenized financial products. But here's where things get really interesting. A major shift has been happening quietly in the background. Traditional finance assets are starting to move onto blockchain networks. This process is often called tokenization. Instead of representing assets like funds or bonds through traditional databases, they can be represented as digital tokens on blockchain systems. This could potentially allow faster settlement, greater transparency, and programmable financial contracts. Now, here's where that matters. Some major financial institutions have already started experimenting with this model. Asset managers have explored tokenized funds. Payment companies have tested blockchain settlement, and fintech platforms are exploring global payment corridors. These experiments are still early, but they show something important. The financial industry is testing what blockchain infrastructure might look like at scale. Stablecoins enter the story. Another major development in the digital asset ecosystem is the rise of stablecoins. Stablecoins are digital tokens designed to represent fiat currencies like the US dollar. Unlike traditional cryptocurrencies, their value is intended to remain relatively stable, and they have grown rapidly over the past few years. Why, you might ask? Because they function as a bridge between traditional money and blockchain infrastructure. They allow digital dollars to move across blockchain networks quickly and globally. But this growth has also created new debates inside financial policy circles. Some banks worry that if consumers store funds in digital wallets instead of bank deposits, the traditional banking model could gradually change. So regulators are now exploring how stablecoins should operate. And one thing is clear, stablecoins need blockchain rails to function. They need networks capable of moving value reliably and efficiently. Which brings us back to payment-focused networks like XRP and Stellar. The infrastructure layer. Here's something many people overlook about technological revolutions. The most valuable innovations are often not the flashiest consumer products. They're the infrastructure layers underneath. Think about the internet. Most people remember companies like Google or Amazon, but the protocols that actually power the internet, things like TCP, IP, quietly run the entire system. Financial infrastructures work the same way. Settlement layers, liquidity systems, payment networks. These components rarely make headlines, but they support trillions of dollars in economic activity. And if blockchain becomes part of future financial infrastructures, certain networks may specialize in these underlying roles. Institutional markets are watching, ladies and gentlemen. Another sign of maturity in any financial asset is the development of derivatives markets. Futures and options allow institutional traders to hedge risk and manage exposure. Historically, major asset classes often gain institutional traction. Only derivatives markets develop around them. Commodities, currencies, equities, all followed this pattern. And now crypto derivatives markets are gradually expanding. It's massive. It's so big what's happening right here. Most people aren't paying attention. This allows large funds to participate in digital asset markets in the ways that align with their risk management strategies. When that kind of infrastructure develops, liquidity often deepens and price discovery becomes more efficient. The tokenization trend. Now step back and look at the bigger picture here. Several trends are converging simultaneously. Governments are studying digital currencies. Financial institutions are experimenting with tokenized assets. Payment companies are testing blockchain settlement. And regulators are discussing frameworks for stablecoins. Each of these developments points towards the same question. What does the future infrastructure layer of finance look like? Because assets, if become digital and programmable, the rails that move them become incredibly important. But the real twist is infrastructure stories rarely move quickly. They develop quietly for years. Then suddenly the world realizes the system has changed. Think about broadband internet. For years it expanded slowly. Then suddenly entire industry streaming, online gaming, cloud computing emerged on top of it. Financial infrastructure could follow a similar pattern. Blockchain networks may spend years building capabilities, testing integrations, developing institutional partnerships, and then one day, large portions of financial activity could begin moving through these systems. Here's a question for everyone watching. And if you're still here, I appreciate a like and subscribe. Why not? So here's something worth thinking about. global finance gradually transitions toward tokenized assets and faster settlement systems, which network might be positioned to support that infrastructure? Will banks build their own proprietary systems? Will governments develop national networks? Or could open blockchain platforms play a role alongside traditional institutions? In my opinion, there's no definite answer yet, but the experiments happening today may reveal cues about where the system is heading. So the broader implications, what's happening right now may represent one of the early stages of larger financial transformation, not necessarily a replacement of the current system, but possibly an evolution of it. New settlement layers, faster payment infrastructure, tokenized financial assets. Even if a fraction of global finance begins moving onto programmable digital rails, the implications could be significant because financial infrastructure underpins the entire global economy. So the market often focuses on short-term price movements, charts moving hour by hour, but infrastructure stories tend to unfold beneath the surface, in policy documents, in institutional experiments, in quiet technological upgrades. Those signals often appear before the broader public notes them. Right now, governments are evaluating blockchain technology through the lens of strategic infrastructure. Financial institutions are experimenting with tokenization, and payment networks are exploring faster settlement systems. All these developments suggest something important's coming. The architecture of global finance may be slowly evolving. And if that evolution continues, the networks capable of supporting large-scale financial flows could become increasingly important. The question isn't simply which cryptocurrency moves next week or daily. The deeper question might be which technologies end up forming the rails of the next financial system. And we may already be watching the early stages of that answer unfold. If you found this breakdown interesting, let me ask you something. Do you think blockchain will eventually become part of global financial infrastructure? Or will traditional banking systems adapt and maintain control? Let me know your thoughts in the comments. And if you enjoy deep dives into macroeconomics, crypto, infrastructure, and financial history, make sure to subscribe because the next chapter of this story may already be developing behind the scenes. Well, happy Sunday, everybody. A lot going on today. I want to welcome all the new members of our Patreon, the Crypto Desk Monthly, all the new members of the membership channel. I also want to stress when I say, as financial mercenaries, we don't care what happens. In a way, we absolutely do, because we're looking for movement and motion and some form of clarity in the chaos. We're looking to capitalize off of the chaos that's created by the powers that be, but most people have come to understand this. No matter how much you want one scenario to happen, people are really powerless when it comes to the destiny and the control of the world. It's like rooting for your favorite baseball team or football team, or ice hockey team. It's more of a spiritual thing, but you always hope that good triumphs over evil. But the first lesson I learned on the floor of the Mercantile Exchange was this. Chaos is going to come. The only question you have to ask is, are you going to capitalize off of the chaos that's man-made? That's what you got to ask yourself. That's the question every floor trader would ask themselves before the bell would ring, when they'd be up late looking at their charts. But as the remora, there's a lot of scenarios happening right now. And if you follow the recce, our research, and why, and all the things that we've been following, there's a lot to capitalize. Again, here's a timeline. It's probably about a week out before the Marines dispatched from Japan get to the ME. A lot can happen by then. When the market opens today, currently recording this right now, it's 11:21 New York Eastern Standard Time. Oil might spike much higher. You have the Iranians saying they're willing to let any boats leave the strait as long as it's not U.S. or Israeli, and they're talking about having money traded in renminbi for oil. I don't even know. But I want to get into this because a lot of things that are happening right now are eerily similar to in 2008. Also, the second Iraq conflict, and I'll get into something like that. I remember trading something, WELL, Boots and Kellogg's, company that went through the roof because it was a penny stock on the American Stock Exchange, and I'll never forget it. That was the first thing that I ever really found for myself that just knocked it out of the park, and I was addicted really after that. And I have to admit, that was the first time that I saw all the research that I put into scenarios, and I really capitalized off of it. There was this famous firefighter named Red Adair that put out oil well fires in the States, and someone who used to work with him started this company. And the company trading on the American Stock Exchange, if everybody remembers that, the stock price exploded because when the second Iraq conflict went in, people were afraid that Saddam was going to light oil wells on fire, which he did. This guy's company was going to get a lot of contracts, and it went from like a penny stock almost off like to $5, $7, $8, all around, up and down, up and down. And the capitalizing off of that chaos, I was hooked, and I realized that capitalizing off of the chaos that is man-made can do so much to excel your own life. You can't worry about what's going to happen. To be afraid of an event that may or may not happen is the definition of insanity. Danger is real. Fear isn't. to be afraid of something may or may not happen. I want to talk about the oil shock versus credit stress, the policy dilemma recalling 2007, 2008. Before I get into this, XRP is, in my opinion, it's a quiet accumulation beneath sluggish prices. Grayscale was out talking about how they believe when the Clarity Act is passed, there's going to be a repricing. I made a video in our Patreon and I went over about how the CME and the entire futures pricing, how that could have an effect on metals, whether it be silver, gold. I'm going to do some more content for a members only video on that. But again, when you look at what's happening right now, I need you to take a step back and see where we're going. We're with Columbus right now and we've lost sight of land, right? So we have to see where we're going to go. And that's most important. Okay. Knowing where we're going to go is the most important because we've already left and we're past the point of no return. So this is why having that Gucci conviction, that Gucci clarity is so important. So important. It really, really is. That's why we are the remorers and we're not going to get up like sushi. If you recall it, 2007, 2008, in my view, global markets are entering a macro environment defined by a growing tension between rising energy prices and emerging credit stress. The setup increasingly resembles the early stages of the 2007, 2008 cycle, if everybody remembers that, when a sharp oil rally coincided with tightening financial conditions and ultimately exposed systematic fragilities. If you stay with me right now to the end, you're going to have a bird's eye view of what's happening, the satellite view, and how to capitalize off of this. And again, if you really want to know how we capitalize off of this chaos, do sign up for the Crypto Monthly Desk. Again, better your life. The current environment is already forcing markets to reassess the path of monetary policy. The probability of a June Federal Reserve rate cut has fallen from nearly certainty early in the year to roughly 25%, largely due to the surge in oil prices and the inflationary impulse associated with it. As energy costs rise, corporate margins tighten, bank stocks weaken, and the financial system's ability to transmit credit to the real economy deteriorates. Several key policy thresholds are now in focus. Stay with me. Markets are closely watching oil above $100 per barrel. The U.S. dollar index, DXY. I want everyone writing that down, DXY. We follow this. Above 100, that's big. 30-year Treasury yields above 5%, massive. And the S&P 500 approaching or falling below roughly 6,600. These levels represent macro tripwires. Write this down, tripwires, where policy makers must be forced to intervene. Positioning has already shifted towards risk-off behavior, ladies and gentlemen. However, sentiment has not yet reached the bear panic conditions, historically associated with durable market bottoms. So in our view, not financial advice, anyone that retains any capacity, the next phase of the cycle will be determined by whether policymakers prioritize stabilizing credit markets or responding to inflationary pressure from energy. So if you look at the structural market reality, I'm taking the PhD out of the PhD here, the current macro tension stems from two interacting forces: rising geopolitical risk premium in energy markets and growing fragility within the global credit system. Energy prices have surged as geopolitical risk re-enters the oil market. So massive, ladies and gentlemen. This is affecting everything. The oil trade is affecting. The oil trade now is the dominant trade of everything because it's the easiest to make money, and that's where people are flowing. For the weekly, monthly, and quarterly numbers on Proc Desk, they got to be in that. Supply disruptions, shipping constraints, insurance costs, and logistical delays have structurally embedded a structural risk premium into crude markets. Even if spot prices temporarily decline, the forward curve increasingly reflects the expectation of a chronically higher prices. This is not going away anytime soon, ladies and gentlemen. It's just not. Okay. At the same time, tightening financial conditions are beginning to manifest in credit markets. Bank stocks are weakening, credit spreads are widening, and flows out of high-yield debt and financial equities are accelerating. Remember, I always say we track the flow of assets from one asset to another. That is one of our biggest things, like how you hoist a sail and have the wind harness where you're going. This dynamic matters because banks represent the key transmission channel between the financial markets and the real economy. So the parallels with 2007, 2008 are therefore difficult to ignore. During that cycle, policymakers focused on inflation driven by surging oil prices, tightening policy into a weakening credit system. That was nuts. Anybody that remembers that, every mortgage broker that I speak with, anybody that's in lending, everybody remembers this. We have like nightmares about that. The European Central Bank's July 2008 rate hike occurred only weeks before the global financial crisis intensified. The lessons from that episode is clear. Commodity shocks may initiate financial tightening, but it's credit stress, not inflation, that ultimately drives systematic crisis. Today's policymakers therefore face the same dilemma. Do you raise rates to combat inflation driven by energy or ease financial conditions to prevent a credit-driven downturn? So if you look at the institutional trade framework, this is what we're looking at and what we're telling people that retain us any capacity, the bullet points, the PhD. Stay with me. This is the base case. You manage de-escalation. In the base case, oil prices remain volatile but openly fall to sustain levels above 100 per barrel. Again, policymakers avoid repeating the 2008 era and instead prioritize financial stability by easing monetary conditions once energy pressure stabilizes. This is so important. You want to write this down or rewind this. This is it, ladies and gentlemen. This is the special sauce right here. I can't believe I'm giving this away for free. Under this scenario, the DXY remains near or below 100. The 30-year Treasury yields approach but failed to sustain moves above 5%. Equity markets stabilized near the S&P 500, 6600 region. Institutional investors would likely rotate into Treasuries and Chinese equities, emerging markets and domestic consumer sectors. Small cap equities could also benefit from easing financial conditions. Here's the escalation scenario, because we have to have this. Oil shock persists. In the escalation scenario, geopolitical tensions continue to push energy prices higher. Oil sustained levels above 100, forcing markets to price out near-term Fed easing. The immediate impact would be rising Treasury yields approaching 5% on the 30-year. A stronger U.S. dollar above 100 further weakens the bank, stocks, and cyclical sectors. Equity markets would struggle as higher energy costs compress corporate margins and weaken consumer demand. In this environment, professional investors would increasingly favor defensive positioning and commodity exposure. At the same time, in our opinion of what we're telling everyone, and not financial advice, picking up real assets, cryptocurrencies, and other things at rock-bottom prices. Supply shock scenario. Again, you got to have this. Credit system stress. Most severe scenarios emerge if energy prices remain elevated, while credit markets deteriorate simultaneously. Triggers would include sustained oil disruptions and supply disruptions. Again, continued outflows from high-yield credit and bank loans, weakness in financial equities. Historically, this combination has favored commodities over financial assets and high-quality government bonds over equities and high-yield credit. So, in such a regime, the macro environment would increasingly resemble a stagflatory cycle. Global macro impact, you might be asking? The current macro setup produces clear winners and losers across global markets. And if you want to see how we're going to take advantage, do join the Crypto Monthly Desk. One Tips from the Pits will pay for your entire year subscription. And you will learn this about all the things I talk about every day and what you're following, how to structure and take advantage and capitalize off the chaos. It's not hard. Don't just watch the news. Get off the bench. Commodity exporters and resource-rich economies benefit directly from higher energy prices. Countries tied to commodity production and energy exports stand to see improved trade balances and fiscal revenues. So, if you look at this, by contrast, energy-dependent economies face significant headwinds. Export demand-dependent Asian economies such as Japan and South Korea, which rely heavily on imported energy to produce manufactured goods, would face margin compression and slower growth. Emerging markets occupy a more nuisance position. While commodity exporters benefit, emerging market debt has already experienced capital outflows as global financial conditions tighten. China represents a unique case. Lower energy prices and easier global financial conditions would provide a powerful boost to Chinese equities and domestic consumption. So conversely, sustained energy inflation would intensify existing deflationary pressures within the Chinese economy. With the global equity markets, the most vulnerable sectors are banks, industrials, semiconductors, financials broadly. These sectors are highly sensitive to both credit conditions and cyclical growth expectations. The strategic takeaway, the core macro risk is the interaction between oil prices and credit stress. This is what you have to watch, the most important. Oil versus credit stress. Rising energy costs tighten financial conditions and threaten corporate earnings. Key policy tripwires are now visible. This is very important. Oil above 100, the DX above 100, 30-year Treasury yields above 50%, and the S&P near 6,600 could trigger policy responses. So markets have shifted towards off positioning, but have not yet capitulated. Durable bottoms historically require a clear sign of panic, such as cash levels above 4% in institutional portfolios. Ladies and gentlemen, this is what institutions and family offices pay attention when they're jockeying money around. So you can see the crypto market being small to everything else takes second, really at the bottom of this, as far as I'm concerned. But it's going to be the most profitable going forward, without a doubt. They're just not telling you what they're doing. Credit markets remain the true systematic risk. If policymakers prioritize inflation control over credit stability, the risk of a 2008-style policy mistake increases. So if you look at it like this, the medium-term trajectory increasingly points towards stagflation, unfortunately. So even if oil declines temporarily, the structural risk premium in the energy market is likely to persist. So what smart money is watching right now, ladies and gentlemen, institutional investors are focusing on several forward-looking indicators that will determine the next phase of the cycle. First, Flows within credit markets are critical. Recent outflows include $2.4 billion from bank loans, $5 billion from high-yield bonds, and persistent withdrawals from emerging market debt. Second, positioning data remains important. Durable market bottoms historically coincide with cash, allocations above 4%, collapsing growth expectations, and sharply reduction in equity exposure. Third, the banking sector remains the key transmission mechanism. A decisive breakdown in bank equity indices would signal rising systematic risk and confirm that tightening financial economies are spilling into the real economy. That's the problem. You can see that gas is more expensive, food's more expensive. These things, I would buy things in bulk right now and keep your gas tank full, depending on where you're situated. Fourth, investors are watching the oil market structure. A steepening forward curve with sustained moves towards 100 per barrel would indicate the geopolitical risk premium is becoming structural. Final policy signals will be critical. Markets are closely monitoring whether governments respond through strategic reserve release, geopolitical intervention, tariff adjustment, monetary easing. Bottom line, in my professional opinion, the environment reflects a classic policy dilemma. Inflation driven by energy policies and price versus growing resilient credit markets. Markets are already pricing and responding, pushing out expectation of Federal Reserve rate cuts. However, the deeper risk lies in inflation itself, but in the potential for tightening financial conditions to destabilize the credit system. Key macro thresholds: oil above 100, DXY above 100, 30-year yields above 5%, and S&P 500 near 6,600 represent critical stress points for policymakers. Near-term volatility is likely to persist as markets test these levels over the medium term. However, the most probable outcome is a gradual transition towards a stagflation environment where energy prices remain struck. For institutional investors, the central question is not whether volatility increases, it's repeat 28. Ladies and gentlemen, what I think is most important is I think, and I'm on the camp of this, and if you're still here, I do appreciate a like. Look, it's better. We're in the camp that a rate cut will help the credit market out. We have to address the credit market first, because if that goes off the rails, forget about it. Oil should be dealt with from a geopolitical or a top-down approach, not a financial top-down approach. A change in policies and a change of situations, right? Because why I'm bringing all these things up, and I go back to years in past and things that matter to me, and when I talk about what matters to me, what I am, me personally looking at right now, telling you me, when I can see the patterns and parallels from the last 20 years to what's happening right now, every time that there were these chaotic situations, traders made a fortune of money. Money managers made a fortune of money. They saw all these things coming. And as we go through all this very important stuff, you play the stock market in different places. You play the crypto market in different places. You play the energy. You play the derivatives. You're playing everything, the cause and effect. When you can master the cause and effect that we have, and that's the biggest thing I mastered on the Mercantile Exchange when it was taught to me, that we're teaching people in the crypto desk monthly to master the cause and effect, you're unstoppable as far as I'm concerned. But the cause and effect, like I said, the oil well fighting company on American Stock Exchange, WLL, Red Adair, one of his associates, Saddam going to light things on fire, cause, effect, price goes higher, research, there you go. But I'm going to wrap this up, but let me start with a blunt statement. The market's living in a fantasy. For the past decade and a half, investors have been conditioned to believe that wealth is created through digital abstractions, software multiples, narrative-driven tech stocks, and assets that exist primarily inside databases. But the reality always wins eventually. In 2026, reality just punched the global economy in the face. Today, I'm going to walk you through the data, the regime shift, and why the only winning investment philosophy right now is scarcity thesis. Owning assets that cannot be printed. It's so important, because what we are witnessing right now is the end of deflationary illusion and the beginning of a fiscal scarcity cycle. Part 1, the deflationary mirage. Before February 28, 2026, markets were operating under what I call the deflationary fantasy. The narrative was simple. Supply chains were healing. Energy prices were stable. Central banks were about to pivot, and investors believed we were going back to the post-2008 environments of permanent liquidity and falling inflation. The data proves it. On March 1st, 2026, the real-time inflation metric from Truflation was sitting at 0.778%. Let that sink in. That's less than 1%, less than 1%. That number told the entire market that inflation was essentially dead, which is why markets are pricing in a near certain rate cut from the Federal Reserve in June. Institutional models assume the same playbook that worked for 15 years, well, liquidity, lower rates, higher tech multiples. So capital flowed exactly where you would expect. High duration tech, software companies with no profits, AI infrastructure narratives. Investors were chasing theoretical productivity gains while ignoring the physical inputs required to run the world. Electricity, copper, oil, infrastructure. But here's the thing about global economy. You can't run it on PowerPoint slides and GPUs alone. You still need energy. And energy just became the center of the macro universe. We'll talk about the Hermes shock that broke the cycle. Everything changed on February 28, 2026. The geopolitical escalation around the Strait of Hormuz triggered a shock that exposed the fragility of the global supply chain. And for anyone who studies macro cycles, this should sound familiar, because this is exactly how stagflation regimes begin. And for anyone who studies macro cycles, this should sound familiar, because this is exactly how stagflation regimes begin. Supply shock collides with a debt-heavy financial system, and the result is the worst macro combination possible. Higher inflation, slower growth, stagflation. The initial inflation data is already confirming this shift. In just 14 days, the true inflation index jumped from 0.778 to 1.5%. That means inflation effectively doubled in 2 weeks. It's so huge, you're not even hearing it on the news. This is not a normal economic move, ladies and gentlemen. This is what economists call a regime break. And the result is simple. The Strait of Hormuz is not just another shipping lane. It's the single most important oil choke point on Earth. Roughly 20 million barrels per day of oil passed through that narrow strait corridor. This is about 1/5 of global petroleum supply. Whenever a portion of that flow is disrupted, the ripple effects hit every single industry on the planet. They do. Every industry on the planet suffers. Shipping costs surge. Energy prices spike. Manufacturing costs explode. And suddenly the entire disinflation narrative collapses. So why this looks exactly like 2007, 2008? There's another reason this moment matters. Institutional research desks are starting to notice that macro patterns unfolding right now looks eerily similar to the period before the global financial crisis. This is what everyone's talking about. Back then, the global economy experienced a massive oil shock. Crude oil surged to $147 per barrel. At the same time, credit markets were quietly deteriorating beneath the surface. Eventually, the stress collided, and the result was one of the largest financial crises in modern history. Now, I'm not saying we're going to repeat this event exactly, but the macro ingredients are eerily similar. A debt-heavy global economy and the financial markets priced for perfection. With those three forces collide, something eventually breaks, which brings us to the core of today's message. Because in this kind of environment, most assets lose purchasing power, but a very specific category of assets win massively. But a very specific category of assets wins massively here. Always does. For years, we have repeated the same principle. Again, the scarcity thesis. The best long-term investments are assets that cannot be printed. Scarcity wins, always. It wins during inflation. During stagflation, it wins, and even wins during disinflation. Let me explain why. Scarcity in a deflationary world, in a growing global economy, demand for inputs, physical, expands exponentially. More electricity requires more copper. More transportation requires more oil. More manufacturing requires more metals. GDP growth is literally built on top of physical resource consumption, which means companies that control these resources capture the underlying growth of the real economy. But these theses become even more powerful during stagflation. Scarcity in a stagflation world, when supply becomes constrained. The owners of a scarce assets gain pricing power. So important. So important. Energy producers can raise prices. Metal producers can raise prices. Infrastructure operators can raise prices. But companies that rely on cheap inputs get crushed. They get cut up like sushi. Fresh sushi. Software companies cannot simply double their subscription fees overnight. But an oil producer can absolutely sell their barrel from 120 instead of 70. It's very efficient, the oil market. That's the difference between being digital abstraction and physical necessity. That's why the next decade may look very different than the last one. Again, if you're still here, please do join the Patreon, because this is how we're taking advantage of this. Again, you owe it to yourself to take advantage of this. I'm going to let it be. The infrastructure shift, super cycle. This is another dimension to this story that most investors are missing. The AI boom. Everyone is excited about artificial intelligence, but almost nobody's asking the most important question. Where does the energy come from? AI data centers consume massive electricity. AI is a kilowatt war. I told you that. Training large models require extraordinary compute power, and the compute power requires baseload energy infrastructure. Power plants, transmission grids, natural gas pipelines. This is why we're seeing something fascinating happen right now. And it's amazing in market. I think it's amazing. That's why I gave you my example with WELL. Fossil fuels are rallying. Renewables are rallying. Nuclear investment is accelerating. This is not contradictory. It's a signal. The world is facing a global power shortage, and the companies that build and operate the energy grid are about to become the picks and shovels of the AI revolution. We're going over all of this in the net tips and the pits. This is massive. The data supporting the scarcity trade. Let me show you what the institutional research desks are seeing. According to JP Morgan Chase, current supply disruptions have already shut in 1 million roughly barrels per day of production, with projections of potentially 12 million barrels per day at risk if the situation escalates. There's the cause and effect, ladies and gentlemen, the cause and effect which leads to alpha. Cause effect of chaos to alpha. That is an enormous shock to the global energy system. At the same time, analysts from Bank of America highlight that large oil producers have driven their organic break-even costs below 60 per barrel. That means something incredibly important. Even at moderate oil prices, these companies generate huge cash flows. In other words, they have become cash machines in a tightening credit environment. And when you combine that with inflationary pricing power, the result is one of the most powerful investment setups in the entire market. So here's the portfolio strategy. So what does this mean for investors? It means that the era of chasing digital yield is ending. If an asset has no physical footprint, it becomes extremely vulnerable in a stagflatory regime. Instead of capital needs to move towards three pillars: energy producers, industrial metals, and precious metals. Energy companies are very important. We like Total Energies and Equinor. Again, not financial advice. This is something that we like. They generate massive cash flows while controlling essential resources. Industrial metals like copper and aluminum are the circulatory system of electrification. Massive. Gold remains the ultimate monetary hedge when central banks lose control of inflation expectations. Infrastructure operators, the pipelines, grids, and energy listed may be the biggest winners of all. If you're still here, write those tips down. That's a free one for you for being here. We salute you. Because in an inflationary world, the replacement cost of infrastructure skyrockets, and that drives the value of existing assets higher. Here's our final thoughts, the new macro reality. So for 15 years, the financial system operated in an artificial environment: cheap money, low inflation, unlimited liquidity. That world is ending, ladies and gentlemen. It's gone. What's replacing is something much older, a world where physical resources matter again. Energy matters, metals matter, infrastructure matters. And investors who ignore that reality are going to learn the same lesson every generation eventually learns. The global economy is not built on software. It is built on atoms. And when scarcity returns to the system, the owners of these atoms win, which is exactly why we are positioning our portfolios for the era of physical scarcity. If you want to see how we're doing this, come and join us, because the next decade will not be defined by who owns the best algorithm. Not going to happen. You'll be cut up like sushi. You'll be the chum. It'll be defined by who controls the resources that power the world. And that is where the real alpha is going to be. Again, ladies and gentlemen, this is how investors are staying ahead of the market before the narrative catches up, ladies and gentlemen. It really is. That's what's happening. Again, the scarcity cycle's already started. That's why Operation Print to Win is beginning. The only question now is who positions early enough to benefit from this. So, again, this content's of informational entertainment purposes only and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Ladies and gentlemen, Print to Win, it's coming. It's starting. What we just went over, we have enough scenarios now on the board that we go over every day with our clientels and anyone that retains any capacity to take full advantage of the chaos crisis, to capitalize on the chaos crisis, okay? So we're going to capitalize this in equities. We're going to capitalize on this in commodities and futures. We're going to capitalize on everything. That's why I gave you the story about WLL. I'll never forget that, the conviction of this, right? The news is upsetting and disturbing. Nobody likes to see war. Nobody likes to. But as this soap opera of chaos continues, the only question is, are you going to capitalize off of these great opportunities it gives you? That's it. So to me, when I look at XRP, I look at ICP, I look at HBAR, I look at these three things, right? Again, that's infrastructure for the future. You have ETFs gobbling some of them up. Web 3.0 is coming. Again, the only question is, are you going to get off the bench and take advantage of it, right? So when Operation Printed to Win it begins, you better believe that everybody that's going to look back at these day points and says, wish I should have taken advantage of up, down, up, down. Have a blessed Sunday. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, actualizing why they missed it, telling themselves to never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally, because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opened your eyes. Smash that like button, ring that bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to Crypto Public. We break down the major global banking trends between digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, and stay in the Republic. Love you all.